Hello, everyone. Thanks, everyone, for joining. A little bit of a smaller group than we attracted for the well analysis, but that's all right. This is a little bit more of a dry topic, but very important. So thank you, everyone, for taking the time. So with that, one of the most powerful benefits of investing in oil and gas production, of course, is being able to take a GP position and write off the IDC and TDC losses against all types of income, including active W-2. The trade-off there, of course, is that you do have GP liability, as we all know, coming in as a general partner. So we're gonna get into this discussion. The disclaimer here that this is not an offer to sell securities. This is also not tax, legal, or investment advice, and we encourage you to seek your own counsel. So first, I want to talk about the tax treatment of an oil and gas working interest, and that is captured here in IRS Publication 925. And that is that a working interest in an oil and gas well that you hold directly or through an entity that does not limit your liability, such as a general partner interest in a partnership, which is exactly how you would be participating in the Waypoint Energy Fund. It does not matter whether you materially participated in the activity for the tax year. However, if your liability was limited for part of the year, for example, you converted the general partner interest to a limited partner interest during the year, which we will do in 2028, and you had a net loss for the well for the year. Anyway, the point is here that your liability cannot be limited. You have to come in sort of naked, so to speak, in order to get those active tax write-offs. So when we look at the tax treatment, where did this come from? These rules have existed since the 1940s. They were codified into the Internal Revenue Code in the 1950s. That was a time when we were drilling vertical wells, and about 1 in 3 holes were dry. So a very risky proposition. And that was the incentive for Congress to say, hey, we want to encourage and incentivize private investment in oil and natural gas production in the United States. And they brought these rules in. Today, we drill non-conventional shale, horizontal. We're doing 3 miles, sometimes even 4 miles laterally underground. The technology has come so far that only about 1 in every 100 wells are non-commercially viable today. So the risk has significantly bled off, yet we still have these incredibly accretive tax benefits. But you are a partner in the drilling. So unlike coming into a real estate fund where you're a limited partner and you're putting, let's say, 50,000 into a real estate deal, and by definition, your exposure is limited to your $50,000. That property could, it could lose money and go back to the bank. You'd lose your 50K. You're not on the hook for any recourse debt. Someone could slip, fall, the place could burn down, there could be deaths. You're not on the hook for anything more than 50K. You are a limited partner in that real estate deal. In an oil and gas drilling fund, you have the option of participating as either a limited partner or a general partner. We'll get into that in a minute. But as you come in as a general partner to take these non-passive losses, you should think of yourself and our fund in general as more of a partner in the drilling. We're signing joint operating agreements with the operator. We really are a partner. Even though we're not the one who's operating, we are a partner on this project, and that's how we're able to pass through these tax benefits to investors. Oftentimes, we get pushback from individuals, CPA firms or CPAs saying, oh, you can't take these because you didn't materially participate. We always say, show them IRC 263C and IRS Publication 925. 9 times out of 10, they email back 2 days later and they say, yep, CPA is good. They read it. They understand it now. If for some reason the CPA still is confused, we can put them in touch with our tax counsel, and that solves the problem once and for all. You must invest as general partner, and there is a checkbox on the subscription agreement for general partner or limited partner. But if you want non-passive tax treatment, you have to invest as general partner, and you have to take title as either an individual, as joint tenants, or or tenants in common, or via a revocable living trust, because revocable trusts do not limit your liability, whereas irrevocable trusts do limit liability. So what are we talking about here? The real juice is through these intangible drilling costs. Fully deductible in the year incurred. They offset W-2, business and investment income, any type of income, capital gains, everything. Typically 80 to 90% of all the costs that go into drilling a well are going to be intangibles. So think of it as things that can't be resold when you're done. Whereas tangible drilling costs are the actual physical products that you could sell secondhand. And those are normally depreciated over 7 years. Had to move our faces out of the way there, but they are eligible for bonus depreciation under the big beautiful bill. Now we can choose whether we want to amortize them or bonus them depending on the tax situation. If we have high enough IDCs, we may choose to amortize. That way we get some additional tax benefits in future years, but that's a decision that we'll make at the end of the year once we have clarity on the wells that are in the portfolio. Typically, we are targeting on a $100,000 investment, just for easy math, we're looking to hit about an $80,000 to $90,000 write-off. Last year was very successful. We got a 95.5% K1 loss. And of course, that can go directly against W-2 income. That would mean that if an investor was in the 37% federal bracket and let's say the 11% state bracket, they would essentially have the government subsidize a huge portion of their investment amount, meaning that their actual out of pocket cost to make this $100,000 investment would be $54.15, which is a pretty large de-risking mechanism when you think about it, when you're getting almost half of your investment back from the government who's subsidizing that versus, in a real estate deal, of course, you're getting some passive write-offs, but you have to pay it back. You never have to recapture these. They're permanent. So jumping into the understanding of should I select GP or should I select LP? So let's talk about GP liability and what this encompasses. So technically, as a GP interest holder in the Waypoint Energy Fund, you have unlimited liability, which sounds really scary, but we're going to get into why that's not as big a deal as you might think it is. There are a couple things that we have in terms of risk mitigation. The first is the operators that we're drilling with have massive insurance policies. These are multi-billion-dollar companies. We are not drilling with, Uncle Joe down the street with 3 wells. We are drilling with major publicly traded and private companies, including Devon, Continental, EOG, BPX. These are serious operators. And of course, they have massive insurance policies. We then maintain a contingency fund at our fund level. And I think most practically, we are targeting a maximum interest of 10% in any one well. There are a lot of programs out there that you might see that, particularly where the company that is raising the money drills its own wells, you have 100% exposure to every well within that portfolio. So if there's a catastrophe, you're going to see that's going to impact you at the individual investor level a lot more prominently than a fund that spreads its risk around to a lot of wells simultaneously. And then, of course, after all the drilling costs have been deployed throughout 26 and 27, we will convert the entire partnership to LP in early 2028. So I want to take a moment to sort of put this into perspective. Let's say we have exposure to about 40 wells in the portfolio. We think that's a very realistic target. We ended up with 39 last year, and we think we'll end up with at least the same amount this year, a maximum 10% interest. And then, of course, the Waypoint Fund, which is sitting out in front of you as the individual investor. So if we run through an example here, let's say one well has a catastrophic event, there's a blowout, and someone is tragically killed in the accident. Of course, attorneys are going to sue. The operator's insurance will kick in. And of course, who are they going to sue? They're going to sue EOG. EOG is a multi-billion-dollar company. It is completely administratively burdensome to try and seek out 400 names of $50,000 investors and drag them into a lawsuit. So now, would Waypoint be named? Likely. We'll get into that in a minute. But the operator's insurance would kick in. Even if the suit were to settle at, let's say, $10 million above insurance limits, Waypoint, the fund itself, would owe about $1 million. We are holding a contingency cash reserves of about 5%. And then, of course, we have the ability to divert revenue. So in a worst case scenario, assuming a $25 million fund, which is what we're on target for this year to be about at least a $25 million fund, if you assume that we had no contingency because we didn't manage cash well and we had no revenue because oil prices were to collapse, a $100,000 investor would be on the hook for 4% of their investment amount, or $4,000. So I think this helps to illustrate that while unlimited liability sounds scary, we've had investors ask, "Oh my God, I don't want to invest 50 grand in this and end up losing my house." The economies of scale, and when you put this in context of the bigger picture, you can see that it comes down to a very low dollar amount per investor. And this is really assuming the worst case scenario, that we own 10% of the well that is in question, that we only are a $25 million fund, and that we don't have any cash reserves and we don't have any revenue to divert. Of course, in practice, we are going to have contingency reserves that will kick in if this were to occur. And of course, once we are distributing, we could take a month's distribution and just simply divert it into this to stand in front of the investors. We have had a lot of conversations with our legal counsel, our various legal counsels, on how this works in practice. The good news is that in the 30-year history of the attorneys that we've been working with, in their experience, they've never seen this happen where a non-op fund is named and on the hook. But if this did happen, how it would work is that non-operators, while often not named, we could be named in the lawsuit. Now, technically, you as a GP interest holder could legally be named in the lawsuit. However, your name is not at the county level in public records. It's the Waypoint Energy Fund 2026 LP is the name that's going to be on the county records. And so that would, in practice, if we were to get dragged into something like this, that would be how it would work. However, if you put yourselves in the shoes of that plaintiff attorney and you're going after damages from, let's pick one, ConocoPhillips, are you really going to bother trying to shake down Waypoint Energy, who owns, let's say, 6% of one well in this package? Or are you going to go after ConocoPhillips? And the answer is that it's much more efficient for that attorney to go after a multi-billion-dollar company. And obviously, ConocoPhillips has an entire legal team, will settle this, and they may bill us for our portion, which again isn't really that big of a deal. We have contingencies, we have revenue, and even in a worst case scenario, the dollar amount that would trickle down to the individual investor is very manageable. We do not expect to have a capital call in this fund ever, but if this were to occur, it would be something that we would do everything in our power to insulate our investors from the event. But in an absolute worst case scenario, it's a very manageable dollar amount. This is an example of an insurance policy that's held by Fulcrum for a package of 4 wells that we participated in last year. This is available on a county website. and it just gives you an example. This is public data. It does take a while for this to update on public websites, but in any case, this is an example of an insurance policy that Fulcrum was carrying on that package of 4 wells. I know there's some questions popping up, but we'll get to those in just a few minutes. In terms of titling your investment, so investors may participate as general partner for non-passive tax treatment. It is your choice. As you can see over here, there are boxes for general partner and limited partner. Now, if you are someone who has significant passive income streams and you don't mind that the losses that you receive on your K1 are going to be considered passive, and you're like, hey, if I can get 95 cents on the dollar as a passive loss and I can offset a bunch of passive income, fantastic. We would recommend that you participate as a limited partner. That's why we gave you the choice this year. If you are going to do that, we would recommend that you invest via an LLC. If you're going to invest as a limited partner, it does not necessarily make sense for you to invest as an individual. We would recommend you use an entity. But for most of our investors, the reason they're participating in this asset class is for those non-passive losses. And so we would recommend that you check the box for general partner. We're targeting that 80 to 90% active tax loss for 2026. And your risk exposure will last for roughly a 2-year period at the most before we convert. This is what you're going to see on InvestNext when you're logged into your investor portal. Is most of our investors have already set up investing accounts, but of course you can have as many investing accounts as you would like. You can invest as an individual, joint, through your IRA, as a trust, and many investors will have a trust account or an LLC that they invest in their real estate deals with, and then they'll have an individual or a joint account that they invest in the oil and gas deal with. I will reiterate here that if you have a revocable living trust, you are able to use that titling for a GP interest because a revocable living trust does not limit any liability. And so, of course, you'll still get those active tax write-offs. I would, however, just ping your tax counsel. I would bring your CPA into that conversation just to make sure that they're happy with it. And you guys are in agreement that that the revocable living trust, they're still going to be comfortable taking those non-passive write-offs for you within the revocable living trust. We can also, of course, do a transfer of interest at any time. So if you were to invest as an individual, once we do the GP to LP conversion, you're more than welcome to just ping the team, and it's a one-page DocuSign, and we can move your interest over into an LLC or a trust or wherever you'd like to move it. Again, just a visual representation of the fund timeline. We are about right here. We're going to be open through the end of the year with some early investor discounts that are currently available, but those bleed off towards the end of the year. Distributions will begin in early 2027. Currently, we're targeting January for our first monthly distribution. We have to make sure that all the drilling costs have been spent, have been deployed before we transition the entire partnership to a limited partner. And that will occur, we're targeting a Q2 of 2028 for the conversion. Once again, Tax Benefits Guide talks a lot about this. If you'd like to download it, I think Brittany probably is throwing that in the chat. Thank you, Brittany. Going into the sensitivity analyses, one of the things that we wanted to highlight on the way that we have built this fund, again, this is net of all fees. This is to you, the investor, based on $70 oil, $3.50 gas, that we really want to highlight how the fund performs without the tax benefits so that you can see how the fund is performing raw, so to speak. And then you can layer in the tax benefit here. This tax benefit just assumes an investor who's in a 35% tax bracket with no state tax. So imagine you live in Florida and you're in 35% tax bracket. That is what this is showing you. And something I'll highlight here is that are when you consider the tax refund that you're going to receive based on that, it's our break even is very, very low. Break even's a little higher, and this is why people have asked, why is the break even 50 this year? It's because we were quoting it without the tax benefit. Break even with when you consider the tax benefit is very, very low commodity prices, which we don't really see a world in which we're going back to these kinds of prices with the geopolitical stuff going on. Again, same exact sensitivity, just showing with an IRR versus an equity multiple. Quick review of the investor share classes. We have a 50,000, a 250,000, and a $2 million share class with different investor splits. And of course, the early investor discount is currently at 10%, expiring at the end of May, dropping down to 6% for June and July, 4% in August and September, 2% in October and November, and then 0 in December. And that allows us to effectively reward investors for coming in earlier, and it allows us to buy really high quality assets earlier in the year when the market is not as competitive. This is going to be based on the fund's initiated date, either ACH or wire. It is an adjustment to your unit count. So if you were to invest 100,000 at a 10% discount, I probably should have updated this because I made this mistake in the original webinar, but the unit price is $1,000 per unit. So just move the decimal point over a couple places there. But that's how the math works, is you would divide your investment amount by 0.9. There is, however, no change to your capital balance. Your dashboard will still show $100,000, and your IDC calculation, your tax benefit, is going to be based on your investment amount without the discount applied. So the tax benefit is going to be the same for 100 grand, whether it's today or in December, but your distributions for the lifetime of the fund will be based on that unit count instead of your investor, the dollar amount. Of course, bolt-on investments receive the applicable discount at the time of investment. So if you were to put cash in today, 10% discount, additional cash coming in later in the year would fall in that applicable discount at the time of investment. With that, I'm going to turn it over to Q&A. Let's see, what do we got? So starting with Dan Schultz, I would think most are in this investment for the year one tax write-off. I would agree. Would it be possible to throttle the tangible drilling costs to guarantee at least 90% first year deduction? Yes. We've been in talks with our CPA firm, who's, we've got two accounting firms that we're working with on this fund, and we're going to be working on that. We always want to underpromise and overdeliver, and that's one of the reasons why we've said that we're targeting the 80 to 90% range. Is we want to make sure that whatever we market to investors is fully achievable, and if we can exceed that, then everybody's happy. But we don't want to promise 95% and then end up lower. But yes, great question. Sam is asking, is an LP investor also considered working interest investment? Yes, great question. You would still be a working interest investment. However, and you would receive the exact same losses. It's just that it triggers passive tax treatment, just like real estate. So if you invest in a real estate deal, let's say you invest $100,000 in a multifamily deal, we're going to do a cost segregation, bonus depreciate that asset, and you might get $50,000 of phantom loss on your year one K1. That's all well and good. However, if you were to try and take it against your W-2 income, it wouldn't work. Unless you were a real estate professional and you could show material participation. There are some caveats to that, but in 99% of cases, you can't take that 50K loss against your W-2. And that would be the exact same scenario if you were to invest in the oil and gas deal as a limited partner. So it would just be passive. Now, if you have passive income, if you are a long-time alternative asset investor and you have a boatload of real estate income that comes in every month, and you have passive income to offset, that works. Then you can come in as an LP. You'll take the passive tax treatment of those losses, and you have something to offset with them. But again, most people don't have that situation. Dan's asking, is there any chance it will be oversubscribed on December 15th? No, because what we really like about this strategy is that our capital stack is not fixed. And man, is that a sigh of relief, because we looked at the secured income fund, which oversubscribed really fast. We couldn't subscribe any more than 5 million on that. Wildlight was another issue where it was like we're over and then we're under, and you're playing Tetris with these last few investors because, of course, when you're buying a real estate deal, you can't over raise because then you dilute everyone. You can't under raise because you need exactly that amount to close, right? So the nice thing about these is whatever we raise, we can deploy. We're deploying in chunks that are as little as $300,000. So if a bunch of cash comes in on December 15th, we will absolutely be able to deploy it. The earlier that cash comes in, the easier it makes our lives. Well, really, Mark, he's the one who's evaluating these opportunities and lining them up. And we'll be working very diligently at the end of the year to take in that last minute capital and make sure that it gets deployed in a disciplined fashion. But obviously, when that cash comes in earlier in the year, it gives us there isn't the time restriction, and of course, you have to imagine that these funds get a lot of cash deployed into them at the very end of the year. And so, if you're a seller of a position, you're going to be in a really good spot on December 20th to sell your AFE because everybody wants it, right? Everybody's trying to deploy that capital. So do us a favor, if you can deploy a chunk of cash earlier in the year and do a bolt on in December, that helps us to manage that cash a little bit better so that we're not getting $5-10 million of last minute capital flowing into the fund on December 15th. Now, that does not mean that we're going to tell you no. We're not going to say, no, you can't invest. We will absolutely be able to deploy it. It just helps us if you can deploy a little earlier. So good question. Julie, you're absolutely welcome. Thank you for joining. And Dan, are you still aiming for April 15th for tax documents? Yes. Of course, we can't guarantee it, but we are using, like I said, two accounting firms. So one is on the asset side. They're called Oil and Gas Upstream Accounting. No, I'm sorry, Upstream Oil and Gas Accounting. Very original name, but they are fantastic. They're going to be doing all the asset level accounting. And the CPA firm that we've chosen to work on all of the fund level accounting and the K1 prep already works very closely with that firm. So we're very confident that we'll get the K1s out ahead of the April 15th deadline. Russ is asking, what is the time frame and mechanism to switch investors from GP to LP? Great question. So we will work with our attorney firm. For the fund formation for Waypoint, we worked with one of the top law firms in Houston. They're called Haynes Boone. They've been doing this for forever, and they're a powerhouse law firm. We'll be working in close coordination with them to convert everyone from GP to LP. So basically, it's just moving everyone's position from general partner to limited partner. And at that time, your investment amount will become your maximum liability amount because you will at that point be a limited partner in the deal moving forward. So if there is any sort of an issue with a well, at that point we're LP. Sam is asking, will the distribution start only next year after the close, even if there's income flowing in this year? Good question. There is a chance that we could start distributing in November or December. However, most of the wells that we're looking at, even if they're getting drilled in the next 30 days, it takes about 6 months for us to start receiving checks from that well. The drilling is actually very quick, but then it has to be completed. And then, of course, the resources have to be sold. That then has to work its way through the accounting processes of the company. And when you're talking about multi-billion-dollar firms, that can be 3-4 months in arrears sometimes before they cut checks to their non-op partners. And so even we're looking at a couple well packages that have already been drilled. Those are the ones that are likely to start paying before the end of the year. But I think that January 27 for a small initial distribution is the most likely scenario, and that's what we're targeting. Bonus points if we can get a few dollars out to investors before the end of the year. Another thing that, TJ, thanks for pinging me on that. TJ mentioned something that I think is worth talking about, which is our clawback provision. And so this is something we built into our fund documents this year that says if at the termination of the fund, investors have received back less than 1.0, not considering the tax benefit. So if you invested 100,000 and if for some reason oil prices crater, we have a really bad rash of underperforming wells, and we were to return less than 1.0 capital to investors, the investors would actually claw back all of our carried interest. So this is true alignment where we can't make money unless you are making money. And we thought that was important to build into the fund documents to build alignment with our investors to say, there is no possible case where Waypoint can end up profitable while investors are losing money. So we just want to make that clear. Thanks, TJ. I'm trying to think if there are any other questions that have popped up on the GP liability piece. Again, really, insurance is the biggest barrier. And when you're talking, again, one of our fund strategies, one of our key fund strategies is that we don't participate with small scale operators. We are participating with multi-billion dollar drilling companies. And that's the beauty of the non-op AFE space, is that we can ride those coattails. We, as a fairly small $25 million fund, you got to imagine that, some of these horizontal wells will cost $10 to $15 million per well. So to be able to get exposure to 40 of them at a relatively small size really puts us in a great position. There are some AFEs that we're looking at where we are only a 3% interest owner. And we like that. We like having a very, very small percentage in just a massive network of wells. It spreads our risk around, it spreads our GP liability around. And but any case, if something were to occur, the first and largest line of defense is EOG's insurance policy. The next would be EOG's pockets, right? And then, of course, we trickle down into the small scale of how that would impact an individual investor. Dan, Wednesday is your day. Come to our tax webinar. Dan's asking, is there any recapture on the first year active savings? And that is a resounding no. There is no recapture on IDC tax benefits. The reason for that is that you technically aren't ever getting your initial investment back. If you imagine you buy a rental property, you take the tax losses, and you eventually sell that rental property, right? But you're probably selling it at a profit. That's why the IRS requires you to recapture those losses, because they go, hey, Dan, you didn't actually lose money on that property, did you? We let you take a tax benefit as if you did while you owned it, but now that you're selling it and you're making a profit, you got to give it back. When you drill one of these wells for, let's say, $10 million, you may only be able to sell it for $1 million or $2 million 5-10 years down the road. You're making your money back through the resources. And so that's why there's no depreciation recapture. But we'll dive deep into that. We have our new CPA firm joining us on Wednesday for the tax webinar. Would love to see you there. There will be a replay of that. The only sessions that are not recorded that we're doing, the last week and this week, are the off the record calls with Mark, where he's going through well analysis, because we're under NDA with a lot of these operators, and there are some very sensitive proprietary evaluation methods that he's sharing, and of course some private information on well packages that we have access to that we're under NDA on, so we can't record those. But the tax webinar will be recorded. That replay will be sent out. TJ, parting thoughts?
No, Tate, this was great, man. Thanks for running this. I think hopefully that helps some of the investors that are worried about losing their lake house. It's like
Yeah, exactly.
that's not
Yeah.
the case.
You
Like
do
this
not,
is
yeah, you don't have to worry about losing the lake house. So
yeah,
glad we could put it into context here.
awesome. Yeah, no, great work. Thank
All
you.
right. Thanks, TJ. Brittany?
Oh, that you covered it very well. And thanks for reminding them about the documents. And our team is going through that as investors are signing. So if you have any
Yes.
questions around documents or accreditation or KYC that come up as you're making your commitments or you're going through the commitment process, please feel free to reach out to investors@turbinecap.com. All of our team is on that email and we will be happy to help you with any of your questions.
Thanks, Brittany. That's actually a really good point. Noelle has been reviewing everyone's subscription agreement after they sign. So don't worry if you make a mistake. Noelle will catch it, reach out to you, and she can send you an additional DocuSign with the edits. So don't worry about trying to get through that on your own. If you have questions, obviously reach out to the team. And if you make a mistake, we'll catch it. Don't worry about it. All right. Thanks, everyone. Appreciate you coming in live. And we'll see you next week for the Landman webinar, the tax webinar, another off the record with Mark Fleming, and a final open forum Q&A on Friday of next week. So thanks again.